Pune.
Welcome to a brand new season of NSE Finwiz powered by CNBC TV 18. As we get set to flag off the third edition of Finwiz, we'll continue our initiative of imparting personal finance knowledge to the young employees of the 20 companies that we'll be visiting across the country. And we've tweaked our format a little too. As we begin the episode, I'll be in conversation with our experts on one core topic, and then we'll discuss the other topics of personal finance. And so, to set off this bandwagon, I'm here at the Pune office of one of India's leading IT and ITES service providers, Mphasis.
Founded in June 2000 after the merger of the US-based IT consulting company Mphasis Corporation and the Indian IT services company BFL Software Limited, Mphasis has emerged as a leading IT solutions provider. Through a combination of technology know-how, domain and process expertise, Mphasis offers applications, business process outsourcing and infrastructure services globally. NSE Finwiz visited Mphasis in Pune with the country's finest experts to advise and educate the young employees on investments and financial planning.
And we're now joined by our two very special experts. We have Kalpesh Ashar, who's a certified financial planner and with Full Circle Financial Planners and Advisors. Welcome to the show, Kalpesh. And we have Nikhil Kothari, who's Director and Chief Financial Planner, Etika Wealth Management. Welcome, Nikhil, to the show. And ladies and gentlemen, our core topic today here in Pune is real estate. So Kalpesh, let's start off with you, real estate. I'm sorry to say, but people might not agree with me, but the first thing when you say those two words, real estate, people will say, overinflated. The prices are too high. So what is your view? Are the prices too high? When are the prices going to come down so that, everyday men, everyday people, men, women can invest money in real estate?
So you're absolutely right, Sumit, because whenever the word real estate is mentioned, first of all, estate comprises of many financial assets. But when you attach the word real to it, it automatically signifies property. Yeah. And in India, on property, and especially in places like Pune, Bombay and all the other metros, it's always believed that the prices are sky high, and as a matter of fact it is, there's no denying that. But the stage in which we are right now, probably that sky high notion has broken a bit. So it's probably at more of a stagnant stage at which we are observing the real estate prices to be. So there are many reasons why this is happening, and probably to the layman it might not be known, but that notion is always in the heart of a normal person that you cannot touch real estate because the prices are always high.
Is it a good time for someone to invest, or what would be some of the conditions that someone would need to look at before they feel it's a good time for me to invest now?
See, when you talk about investment in real estate, I am of a very strong view that investment in real estate, if it's pertaining to your first house, you should go into it without any hesitation.
Okay.
So probably looking at your financial condition, profile, at which stage of life you are, and if your intention is to buy your first house in which you're going to reside, then you should take the plunge.
Okay.
And probably we are at that stage right now where people who really want to get into buying their first house for residing, their end use, this is the right time probably to get into it.
Okay.
But when you talk about when should they get into it, then you shift the topic to as an investment, second house, third house, luxury home, lifestyle, I think then you are diluting the topic a little bit more.
Okay. So Nikhil, I'll come back to, so Kalpesh is saying first house you should buy. So basically sticking to the old Indian notion that ghar to hona hi chahiye, get a home done. Fine. But would that be, so is it okay to take a loan to get that first house?
Okay. See, first house is not an investment. It's for your consumption. So you're not looking at that from an investment perspective. So when it's for consumption, now when you're buying a first house, when you're planning to residing in, that might cost you beyond your financial need at current juncture. And so you need to take a home loan. And home loan is the best loan you can ever get it.
Okay.
There are a lot of benefits when you take a home loan. First of all, when you pay the principal amount for your home loan, that you get benefit under Section 80C. And whatever interest you pay, okay, up to 2 lakh rupees, you get tax benefit.
Okay.
So say for example, if you're taking a home loan for worth rupees 20 lakh rupees, and you're paying a EMI of 20,000 rupees, okay, and overall you're paying an interest of around say 1 lakh or 2 lakh rupees, that whole interest is given you as an exemption. Okay, so you can reduce the overall interest you have paid from your overall income. So effectively, if your loan is around say 9% or 10%, if you belong to 30% tax bracket, so effective home loan rate is only 6 to 7%.
Okay, that's good.
So it's very good to take a home loan. It's always advisable whenever you're buying home, you should always go for home loan.
Is there a quantum, like I can say that I earn X per year, so my loan amount should not be more than half X, 2X. How do you decide your loan amount? Because you have to, in the end, you have to repay it from the money that you're getting through salary or business or whatever whoever is doing.
When you're deciding the EMI, you need to look at your cash flows, so how exactly your cash flow is managed.
Yeah.
So basically, as a thumb rule, what we say is that your EMI component should not be more than 35% of your monthly salary. So 35% to 40% should be your thumb rule. That much should be the maximum EMI you should opt for.
Okay, great. Saket says that what factors to keep in mind in investing while investing in this new era of smart cities? So these are apart from metro cities. But what should be kept in mind while investing? And we were also talking about how will this hype of smart cities affect Pune and other cities?
So answering that question about the smart cities, see, there's a certain guideline which has just come out, issued by the government, that what would be the parameters of a smart city. So all that is coming out slowly in print, because it's a great vision which has been laid out by our PM, and he's going to identify these 100 smart cities. Now, when you are planning to invest in a smart city, probably again the focus, or I would say not the outer focus, but the introspection should be, are you ready for it? Smart cities will keep on happening. Pune already is a smarter city, and I would say smartest city. So there are other places which are being developed now throughout India. Now, when you invest somewhere, probably say which is outside your reach, and real estate is a physical investment. So you should be able to know that will you be able to monitor that investment. So tomorrow, if there is a plot or a city which is, say for example in Bihar, which is miles away from here, and you would like to say, okay, that's a smart city and I would like to invest in it, that's a great thought. But would you be able to monitor it? So when Sumit asked the question, what are the parameters? The first thing is, will you be able to monitor that investment? Second, how concrete or how much do you know about the builder who's going to do it? Ultimately, it's the builders who are going to do it for you. So the parameter might be a smart city, the broad framework, but ultimately it's your money which is going to go there. So if really you're looking at an investment or something, do an investment which you understand, which is closer to you, and second, you can hold somebody responsible for it.
Next question is from Bhushan Ghorpade. So he says, is it better to buy land or to buy a flat?
See, again we come to the question of credibility and I would say ambiguity also. So when you're buying land, there's a lot of ambiguity. There's a lot of ambiguity in buying land, and you don't have anything in front of you. I think all the title deeds, and I think a land expert would be able to tell you that. They have all the tehsildars and you have to go through that, whether the clearing is proper and all. And I really think it gets more and more complicated if you're looking at buying a land. Although the returns promised on paper, that you buy a land, it's much more cheaper and it will give you multiple returns over the years, all that is fine on paper. But to get that clearance, if you know the process well, get into it. Otherwise, just a simple comparison, land and flat is a better option.
On that note, it's time for a very short break. You're watching NSE Finwiz, powered by CNBC TV 18. We'll be right back. Welcome back. You're watching NSE Finwiz, powered by CNBC TV 18 Season 3. Now, Nikhil, I want to start talking about our other topics of personal finance, because there are a lot of other facets of personal finance that we need to look at also. So first up, let's talk about fundamentals. The importance, what are the first few steps that I should do so that my financial planning, the future plan is in order? There are some things, there are some important things that people miss out.
Okay, so the first thing on the financial planning starts with something called as a life insurance. Okay, what is life insurance? That if something happens to me, my family gets a lump sum money and will take care of all our future requirement. Now in life insurance, people buy there are a lot of life insurance policies, but the only insurance you should buy is called as term insurance. Okay, so what is term insurance? That I take a cover. Okay, so you take a high cover. So for example, if you take a 1 crore, 2 crore cover, at your age, most of the premium will be around 10,000 to 20,000 rupees per annum. So you pay 10,000 rupees and you're covered for next 35 years. So in next 35 years, something happens to you, your family gets 1 crore, and nothing happens to you, whatever premium you paid is forfeited. Why is this important? Because this gives you financial safety or mental peace that if I'm not there tomorrow, my family will not suffer financially. So that's the first step of being a financial plan. That take a term insurance. Second,
sorry to interrupt you, but general question is that if I God forbid if I die, my family gets the money. If I don't die, then that money is literally like down the drain. So that hurts people. They're like, hard-earned money is just wasted. It means you're like, no, I don't want to live long also because that money goes down. How do you counter that?
Okay. Yeah. So say for example, if I take my personal example, okay. So when I took a term insurance, I have broadly 2 crore term insurance for which I pay 15,000 rupees as a premium. Okay, and I'll continue paying this premium for next 30 years. So what is the proportion now? I pay premium for next 15 years. If something happens to me, my family gets 2 crores. Okay, even if my wife doesn't know anything about finance, she puts this money in fixed deposit. She gets around 18 lakh rupees a year, so 1.5 lakh rupees a month, which will take care of her. Now, if nothing happens to me in next 30 years, whatever premium I paid, 15,000 rupees per annum. So next 30 years, I paid 4.5 lakh rupees. So you're not happy that you survive for next 30 years. You're sad that your 4.5 lakh rupees is gone. What is more important, whether you survive for 30 years or 4.5 lakh rupees? So I think you can take a very clear call that what is more important. And if I survive for next 30 years, the amount of money which I will earn and I will save, I will have a huge corpus that this 4.5 lakh rupees will not matter to me at all.
Okay.
Just a peanuts.
Okay.
So earlier on you said that 35 to 45% of your income should go into, in case you're looking at a house loan or a homing loan. Now what happens is, if you have taken a loan or perhaps not taken a loan, both the scenarios, how much of an income should ideally, we as young individuals really look at targeting as from the investment perspective? I mean, what could be an ideal amount that we can look at in a long run, considering I think most of the people have two major things. One really looks forward to. One is perhaps child in case they are married, and a long-term retirement benefit.
I think what your question is that if 35 is allocated to repaying loans, how much should you income component towards investment be? That's what you're asking,
Precisely.
Right? Yeah, okay. If you say that, out of the 100%, 35% is towards a repayment exercise, which is an EMI. Ideally, to start off, we would say that 25% should be dedicated towards investments. Because that remaining 40%, so 35 is towards an EMI or a repayment. If 25 is towards investments, the balance amount is towards your day-to-day expenses. So everybody spends almost half his salary, or income, in his day-to-day expenses. Now, coming to that 20-25% which you are looking at of investing, this is not savings. There's a difference between savings and investing. Because savings is stagnant. It just gives you a mental satisfaction. I've got X amount lying in my bank account. We do not want the word lying. It should be moving. So when you say investing, it should earn returns which are better than inflation. So if your existing inflation today is 7%, what is your endeavor? What are your steps which you take that your investments will earn you more than that? So that answers that. Probably for starters, we personally believe that 20-25% of your income should be dedicated towards active investments.
This is NSE Finwiz, powered by CNBC TV 18 Season 3. It's time for a very short break. Don't go anywhere. We'll be right back. Welcome back. You're watching NSE Finwiz powered by CNBC TV 18, and today we're at the office of Mphasis in Pune. Kalpesh, so we've spoken about a wide variety of topics. We've spoken real estate, we've spoken mutual funds, and we've spoken about all other types of investment. I want to go a little, let's zoom out and talk about the mother, the umbrella all over it, which is the word diversification, asset allocation. Again, two words that people might read in the papers or in financial portal. What is diversification, asset allocation, and why is it important?
Okay, when we use the word diversification, it stems from that old adage which we all keep on saying. I don't like saying it, but I'll say it, putting all your eggs in one basket. Okay, so do not put all your eggs in one basket. It stems from that fact. But it's much more complicated and much more detailed rather than talking about that. So when we say diversification, it also surmounts to something which goes to a financial behavior. That, everybody all of us are certainly biased towards certain investments. Now that could be because of our family background, of what we hear about peers. So if everybody is talking about equities, obviously right now the flavor of the season would be that the stock markets are doing well. So why not, if my neighbor is doing it, that neighbor's envy, owner's pride type of a situation. And even I would like to get on into it. So what people do is that whatever is the first thing they get in hand, they put that money into equity, not knowing that what the other person has done with his equity, how long has he been invested, is that part of his full portfolio or is it 1/10 of it? And then that is where you make a big blunder. So people just get flown with the tide. Diversification talks about basically just balancing your risk. And this risk element which is there again is linked, we keep on saying what I said earlier, is goals. Your goals should not be jeopardized in whatever you do.
How good is to invest in gold rather in market, because like gold is like traditional way of like investment, and it is always said like gold beats the inflation. Okay, because like if I'd say like before 10 years, like what my dad has bought some part of gold, it was like it is 3 or 4 times right now. So is it good to invest in gold or not 100% of my investment? Maybe a majority of it.
Okay.
Is it good?
Nikhil, you want to take that?
Okay. See, gold is a hedge against inflation. So in a long term, gold will give return in line with inflation. But when you are doing investing, okay, you want return which will give you, the investment should give you a return far more than inflation. Because if you're investing just in line with inflation, you are at the same level. You want investment should give you return more than inflation. And gold can't give return more than inflation. Okay, gold will always be hedge against inflation. Now again it comes to what exactly your specific goals is that. If you're saying that okay, I'm saving for my daughter's wedding and need some portion of money which I need to buy gold in future, that portion I can invest in gold. But if you're really looking from long-term investing, that I want to create wealth, gold is not an asset class for you. To create wealth, you need to invest in financial assets, and equity will be the best option for you. But gold is only a hedge against inflation. From an overall portfolio, your 5% of a portfolio can go in gold, not beyond that.
And the point about, of course, there was a period in the middle when gold like really zoomed. So what you were talking about, it's double, triple, quadruple, but that was a certain time period. So at that time, yes, so there was a time period for real estate also. Everybody who had bought a house at maybe 1 lakh became 1 crore. So there was a time for those assets at that time.
Gold didn't come from 2 components. One is that it's inflation, and whenever there's a financial crisis, and gold is always a preferred asset class. But financial crisis is only for a short period of time. Financial crisis will not be there for 10, 15, 20 years. Right? So that in that short period of time, gold can do good, but not the long term. If you look at last 3 years or 4 years, there's no movement in the gold.
Aren't there any insurances which give returns as well as money at the time of retirement?
So insurance that gives you money back insurance kind?
Money back as well as money at the time of retirement.
Okay, sure.
When you talk about getting money back from insurance products, apart from, there are 2 types of things. There are traditional and the endowment plans, which has been seen that the returns whenever you get it on maturity are always in the region of anything between 4 to 7%. So that is the traditional way of looking at it, and that returns is not something to go gaga about. That is not even beating your inflation. The second type of the insurance cum investments which we are talking about is the ULIP, which is linked straight to the market. Now if you really want to do a market related investment, then we've already talking about mutual funds and direct equity and all, in which things are more transparent. Although ULIPs are getting a little bit more transparent after a lot of discussions on them. But still, why would you want an ambiguous product rather than a clear, transparent thing which is in front of you? So keep the two things completely separate and don't, look at your insurance bringing you any investments.
Well, that's all the time that we have here today. Thank you so much, Kalpesh. Thank you so much, Nikhil. And thank you so much for having us here. Thank you.
The session was great and it gave us clear knowledge on how to plan our investments, about the retirement and different types of financial investments are there in the market and how about to go on, start our investments, and it was really great session. It was very helpful.
The program was great. Actually, it gave us a lot of knowledge about how we have to invest and what is the right time to invest in funds.
Well, that's all on this episode of NSE Finwiz powered by CNBC TV 18. And here's a chance for you to tell us how much you've learned on the episode and for you to win some goodies.
Under what section of the Indian tax system do you get a rebate on home loan? A. 80D, B. 80C, C. 89, D. 87A. Send in your answers on fwq@network18online.com.
We'll see you next week from another company with another set of young employees. Until then, from the entire team, many thanks for watching.
Focus, ideate, innovate, enable.